next preference is called pro rata rights. Pro rata rights is basically you've negotiated for a certain percentage ownership of the company, and you have the right to keep that percentage ownership even as new investors show up who would otherwise dilute you, right? Or in other words, you're allowed to buy, if you own 25% of the company, you get to buy 25% of the new shares that are being sold. It's the same difference. And so it's the right to, keep up with the Joneses and keep up your ownership. It's also, you can think of it as the right to just be in the next round. Because if you don't have pro rata rights, the entrepreneur doesn't have to let you invest in the next round. This is really important to venture capitalists. It's part of their business model. They need the pro rata rights. For angels, usually when you get a company that's growing really fast, well, if you have a company growing slowly, then nobody else wants to invest. And so you get called upon first and only to invest. Doesn't matter if you have this preference. If the company's growing really fast, then usually gets to the stage where you just can't keep up. Like if you were 20, you're owning, let's say 10% of the company is your piece, and they go and raise $1 million. Well, then 10% of $1 million is $100,000 is your pro rata rights. And so usually that's just too much. And if they raise $2 million, it's $200,000. So usually you can't keep this right, but you have it, which means you might be able to use it in some negotiation somewhere with someone else you want to bring in. But it's really common in venture capital terms. Let's go on to the next three. They're related, so I did them A, B, C. This is usually not a preference that the shareholder has. This is a preference that the company has. So the first one and the strongest version of this is the right of first refusal. Right of first refusal says that if a buyer and seller agree to sell shares in this company, that the company itself has the right to simply buy those shares at the negotiated price without the buyer having any veto power whatsoever. So this shows up in a few places. So you're going along and you own a piece of a company and it's doing well, but something happens in your life and you just need some money. And so you want to sell some of those shares, especially if they're up a lot. Like you could have something on paper that's grown 5 times or even 8 times what you paid for it, but it doesn't actually have any liquidation value yet. And you're talking about it to somebody over drinks, and they go, "Well, I would buy some of those." And so you come up with a price, and you negotiate it. Well, if there's a right of first refusal by the company, you have to tell the company. In every case, you have to tell the company because they have to do something to document this transaction. And if they have the right of first refusal, well, they can say, "Well, that's nice. I know you like this, buddy, but we're going to take those shares back." So they can get rid of some shares and undilute everybody if they do this. This happened to me at one of my companies. So we were in the midst of a divorce. The ex needed some money. So as we were negotiating, we hadn't even finished the divorce yet, but she needed some money. She didn't have a job. And so we said, all right, we'll sell some shares of the company. And so I went to the company and said, look, I know you have a right of first refusal. So before I go and try and find a buyer that you're just going to take from me, do you guys have any buyers? And so I used this in my favor. And they went back, and like a week later, I got an email saying, yeah, and here's the price. And I laughed and I said, that's nice. I'm not selling them at that price. And I named a price, and we settled it, and I sold the shares. So I used this right of theirs to jump ahead of any investor to negotiate for them to buy some shares back. The softer version of this is the right of first offer. So instead of the company can always jump in front, they simply have the right to jump in and bid the same amount or bid more. So they have the right to have an auction. And the weakest form of this is just the right to be notified. And you can, in fact, throw these in on the investor side if you want. You can try if it's important to you. And so big investors might do this as well. There might be a preference in the Series A when the venture capitalists come in that say, well, the company has the right of first refusal. We have the right of second refusal. So if the company doesn't want it, then we have the next right to buy it. And that happened to me at my next company. Again, it was divorce time, and I had some shares of that company as well. And so we went to go and sell them. And I had a buyer at that point, and my venture capitalist jumped in. It was a right of first refusal, I think, in this case. They just jumped in and bought them instead. I still got the same amount of cash. It was fine for me as a seller in that case. All right, moving on. A really common term is drag along rights. So drag along rights simply say that if a certain percentage, which is usually supermajority, it could be majority, but it's usually supermajority, where supermajority is usually 60 or 67%. So if enough shareholders say they agree with something, all the minority shareholders have to go along with it. And so this is a protection. Again, this is on the company side, but it's in the stock purchase agreement. It's in the documentation for the purchase of shares or the shareholder agreement. And this exists both at the level of a class of shares. So it may be that if 67% of the Series A investors agree to something, then there's a drag along right within Series A. And it may be for all shareholders. And it's usually for all shareholders, so that when enough of the shareholders say that we're selling the company, nobody can just put their foot down and say, no, we're not, right? You have to go along with it. So this gets rid of a lot of the minority shareholder issues that come along, where either they get in the way because they have their own agenda, or they get in the way because they just don't communicate. This is really important when a company has a lot of investors on its cap table, and not all of them are reachable, not all of them write back. So in this case, you just need a majority or supermajority to say yes, and then you can move on and just say it was passed, just like democracy. Those are the biggest of the preferences, and you can find more details about all of those online if you just search for them on Google. There's lots of blog posts. There's a really good Brad Feld book on being smarter than your VC, which covers all these preferences in great detail.